Do you have to do a presentation on this one?
All right, so welcome to today and this week. So this week we're going to be talking a bit about risk analysis. We don't have a large class so far, but people will probably be trickling in throughout the class. Now, before we start, just wanted to put everything into context. So risk analysis is trying to understand the underlying risks that the business is exposed to. The whole reason why we're doing risk analysis is because it helps us in the future. So in the future, when we specifically next week, when we need to start forecasting various ratios, we need to figure out what is a normal range for that ratio. So say, for example, if we look at profit margins. So last week we already started by looking at ratio analysis and trying to understand why has profit margin, for example, gone up and down, and trying to explain all those changes. What risk analysis does is it adds another facet, in the sense that you can try to understand, are there any external risks that the company is exposed to that may actually push this profit margin down? So profit margin is one of the examples, but effectively what risk analysis does is it provides you with an idea that you need to be able to understand all the risks that the company is exposed to and how it will impact either the returns in the future or the risks associated with generating those returns. Because again, if we're looking at valuation, practically speaking, is not very difficult. So in, I think, topic 6 or 7 this semester, you'll be doing something that looks similar to this. So it's a discounted cash flow model. Now again, a discounted cash flow model, it's not that advanced, because all that you have here is that you have your forecasted net profits and you're discounting them back to the present period. But all of this is driven by assumptions. Now, probably the most important assumption, and the one that's most subjective really, is the weighted average cost of capital. And the weighted average cost of capital is, again, it's merely just an operationalization of the associated risk with this business. So weighted average cost of capital, it's a terrible thing to use in practice, but it's the only thing that we have. So whenever you go through a financial statement, it's in the notes, you might have already done that in accounting analysis, and they might have talked about the fact that we use the discounted cash flow analysis and we a discount rate of 7%. Well, that discount rate has been estimated using the weighted average cost of capital. But as you'll see when we get to, I think, topic 6, when we talk about the cost of capital, is that the weighted average cost of capital and the way that we estimate discount rates in practice, it's highly subjective and it's very much open to interpretation. So risk analysis more or less allows you to understand what is actually driving that, because really the weighted average cost of capital is supposed to be capturing the relative risk of the company and how risky it is. So if you understand the risks that the company is exposed to, you should be able to understand what is an appropriate weighted average cost of capital and what is not. Because just because the numbers tell you that the cost of capital is 6% does not mean you need to use 6%. Because if you know that, qualitatively speaking, based on everything you know about the business, that it's actually a much higher risk, then you can actually adjust that. But again, even when we look at, for example, the net profit margin and so on, so again, this model is based on the fact that we start with net profits, we get back to cash, and we discount those cash flows. These net profits, these cash flows, are all based on the forecasting week. So the forecasting week, which is what we'll do next week, it works on the basis that we have some historical data and we have forecasts. So the historical data and the forecasts that are driving our kind of discounted cash flow analysis is based on the various ratios. And this is kind of what we started out doing last week already with the ratio analysis and trying to explain why things move up and down and so on. And again, the reason why we're looking at it and the reason why we want to try to understand it is because we need to provide inputs for the forecast. So if something has gone up and down in the past 5 years, what is a reasonable number to forecast, for example, for the gross profit margin? So all of those things need to be decided on next week, and you need to be able to justify it. And the way you usually justify it is by having a good understanding of why things went up or down. So it could be because the company is exposed to a huge risk around fuel prices, and fuel prices skyrocketed last year, which drove profit margins down. If you're aware of that, well, then you can start to model that into your assumptions for the future. So one of the things that I guess the people who might have already done the homework for this week might have noticed is that I gave you guys an example of what this end result might look like for this week. So on iLearn, I uploaded an example of a research report that is actually from the CFA Research Challenge. So every year the CFA organizes a research challenge where basically groups of students come in and value a company and give a buy, sell, or hold recommendation. Part of that is that they do some form of a risk analysis. So again, I can kind of show you the whole report, but basically this is the presentation, it looks pretty nice and so on. But part of it, and this specifically one, I think it's a school from South America that they analyzed a South American airline. And part of this report is risk. So if you go down a bit, again, this is up on iLearn if you want to look through it and if you want to get inspiration for your own presentation. Part of the report is risk, and that is essentially trying to classify and basically identify all the various risks that the company is exposed to. Generally speaking, the best way to kind of provide an overview of this is by doing something like this. So this is called the risk matrix, and it's really just trying to plot all the identified risks according to the probability and the impact. So what is the impact of the company and how probable is it that this will happen? So generally speaking, if you have a lot of risks in this quadrant, so there's low probability and low impact, it's not that big of a deal. But obviously, if something has a high probability of occurring and will have a huge impact on the business, it's something that you need to strongly consider in your forecasts and your kind of risk models. So for example, this is about an airline. So higher jet fuel prices has a high impact, and there's a medium probability that this will occur. So again, you might say, how do I actually figure out all these various risks? So how do I figure out higher jet fuel prices? How do I figure out availability of credit, currency fluctuations, all these things? Well, the nice thing is that usually, not for all companies, but usually this will be disclosed to a large extent. So to a large extent, most firms out there will have in their notes a description of all the operational and kind of market risks that they're exposed to. So in H&M's example, for example, they have several parts of their annual report where they talk about the risks that they're exposed to. So H&M, I think on page 73 and 74 of their annual report, talk about specifically operational risks, which is to do with their business operations. Then later on, they have a section for financial risks. So you essentially have categorization there already. So for example, we have operational risk and reputational risk is one of them. So the fact that they have a strong reputation, but because they have a strong reputation, they're well known. Anything that happens in, I guess, public that might negatively affect them might negatively affect the sales of H&M. So again, we all know that a few weeks ago, there were kind of a controversy around I think ads in South Africa, I think they had, got in trouble with riots and all these sort of things. And again, that's reputational risks. And again, reputational risk will impact their sales. But again, if you kind of go down, you'll see, for example, they have something called fashion. So fashion risk is basically the idea that everything they do is about predicting trends. If they are bad at predicting trends, they have a lot of stock that they can't sell. Even if we look at down here, there's something called weather risk. And again, you're selling seasonal clothing. If the weather is abnormally warm during the winter, people don't need winter jackets to such a large extent. But again, these are very much specific to H&M. So the idea is that the annual report, and specifically the notes section, will provide you with a long list of risks that H&M has disclosed for you. And you will be able to use those risks to, again, make something like this. Because again, for each risk, you need to understand what is that risk and what is the impact of the company and how probable is it that this will happen. So I want you guys to kind of create a risk matrix basically on the Thursday session. And what you'll see here as well is that they've categorized the risks in terms of market risk, operational and financial risk by doing some form of color coding. So again, I'm just saying you don't have to do exactly this, but this is nice to use as an inspiration. And if you were to go down the next few slides, they kind of go through a few of these risks. So for example, deterioration of GDP growth. So the fact that GDP growth is going down in Latin America, what will this impact and so forth, and there's more information. On the next one, it's about jet fuel prices and labor costs. So the fact that they might have lower margins because the operating expenses will be hit if the jet fuel goes up, if the labor costs go up. So the idea is that the risks are not something we'll look at in isolation. Risks have an impact on something to do with the forecast, something to do with the cost of capital. So usually it will be something around margins, sales. So what is this risk going to impact? Because if it's not impacting our financial or our cost of capital, it's not necessarily a risk. So when you analyze a risk, you always need to consider what does this impact. So again, this is just one example. You can Google and you'll find more examples and so on. But again, a lot of the work in terms of identifying some of the major risks have been done for you. So you're basically just trying to extract it. And again, for some of your companies, you might not have this luxury in the sense that your company might have a really bad annual report, in the sense that their note section is non-existent, in which case generally what I say is find a similar company, a competitor, because they will usually be exposed to very similar risks. So if your company does not disclose these separately, find a similar company, they'll have a disclosure of their risks and they will be quite similar. But again, usually they should be disclosed. So again, the whole reason why we're doing risk analysis is it provides us with more information about the company and a greater understanding. Because again, as I mentioned kind of in week one, the majority of evaluation is really just understanding the business, because the numbers and putting in those numbers is the easy part. It's justifying those numbers that becomes difficult. And the justification comes directly from having a good understanding of the business, the industry, the market, the risks, and so forth. Because if you can understand those, well, then you can put into words why you believe net profit margins will be 27% in the future, why sales growth will be 5%, and so on. And again, you might say, Tim, I don't know exactly what it's going to be. Even people in industry generally don't know what things will be in the future. They're just guessing. So all you really need to do is provide your best guess. So the knowledge that you have about the business allows you to more or less justify your guesses. And that's all I ask of you. I don't expect you to be experts and knowing exactly that sales growth will be 6% next year. Provide your best guess. And you can usually guess better and justify that guess in a better way if you know more about the business. Now, when we're looking at risks today, we're going to be looking at two particular types of risks. So one is disclosed risk, and the other one is non-disclosed. So disclosed risks is something that's quite simple in the sense that it's usually disclosed in the annual report. So usually, like I showed you in H&M's annual report, there will be a number of risks that are disclosed, and these will be operational risks to do with the operations of the business. There'll be some financial risks and so forth. But these are risks that have been identified by the company that have been disclosed to you. However, there are some non-disclosed risks which we will also consider this week, which is to do with bankruptcy risks and financial reporting manipulation risk. And again, if you've done the reading for the prior weeks, you might have already noticed that both of these things have been covered in the past few weeks. So bankruptcy risk was covered in last week's reading, and financial reporting manipulation risk was technically covered in the reading for accounting analysis. But again, today we're looking at it from a risk perspective, in the sense that we're using quantitative models to identify risks that have not been disclosed to us. So again, as I mentioned, most accounting standards out there, so US GAAP and IFRS, both specify that the company needs to communicate to their shareholders about the risk that the company is exposed to. The way that they do it will differ. So some companies are pretty straightforward in the sense that we'll have a section in the notes that probably is called risk exposure or risk or something around risk. And they'll be very specific. These are the market risks, these are the operational risks, and so forth. And these will be the disclosed ones for this company. again, even those firms that don't have a separate section, so it's not as easy for you to figure what they are, they will most likely be sprinkled throughout the annual report and throughout the notes section, but it won't be a separate section in itself. So it makes life slightly more difficult, but again, according to accounting regulation, the firm needs to communicate the risks that it's exposed to. And again, when we're looking at commonly exposed risks, things like commodity prices, foreign exchange rates, interest rates, litigation, credit risks, these are probably the most commonly disclosed risks. So even if you think about H&M or a clothing retailer, if they manufacture their clothing, well, commodity prices, so the material of cotton, basically the price of cotton, wool, and all the kind of synthetic materials that they use, if it goes up, well, then their costs go up. If their costs go up, the profit margin goes down, profits go down, and so forth. Foreign exchange, again, if you're looking at any company these days that has a multinational presence, foreign exchange risk will be quite a significant one. So for H&M, which probably has, let's see, I think if we're looking at H&M in general, so it's headquartered in Sweden, so it's basically its operational currency or home currency is Swedish kroners. If you look at its revenues, probably about 99%, I would guess, are from countries that don't have Swedish kroners as their currency, because it's all from abroad. Because their biggest market, I think, in Europe generally is Germany, and outside Germany it's now US and so forth. So most of their money is actually collected in a currency that they don't report under. So they report under Swedish kroners. So if there's huge fluctuations in currencies, well, suddenly our sales projections might be off target because we might have projected at a certain rate, but we didn't necessarily account for the foreign exchange rates. And again, usually you might do things like hedging and essentially buy a contract to lock in at a certain exchange rate and so forth. But again, there will still be some foreign exchange risk that you're always going to be exposed to. Again, other types of risk like interest rate risk, credit risk, and so forth. But again, all of these are examples of disclosed risks. So these are been disclosed to you, so it's not necessarily that difficult to find. I should mention that just because something is not disclosed does not mean it's not a risk. So the company should be disclosing these things, but they might not be. Which is, even if your company does have a nice section in the notes that specifies these are the risks, maybe compare them to a close competitor and see if they're similar. If you see that your competitor has a whole bunch of other risks that they've listed, maybe consider, well, should this maybe also be a risk for our business as well? Now, in terms of, I guess, the bulk of today and what we're really focusing on in terms of, I guess, trying to understand, and specifically, I guess, the slightly more difficult part is really around non-disclosed risks. So again, accounting standards say that they need to disclose certain types of risk, but there will be certain other types of risks that are just generally not disclosed. So some of the non-disclosed risks will be, for example, bankruptcy risks, so the fact that the firm might go bankrupt. Generally, they might need to communicate to the shareholders about their problems or solvency and so forth, but they're generally not going to be super straightforward about it. The second part is financial reporting manipulation risk. So if you remember in the accounting analysis, I said that in most cases for publicly listed firms, you won't find any big red flags. One, it's because the auditors would have done their job, and it's a publicly listed firm, so a lot of people are monitoring this business. But two, if you're doing some shady stuff, you're not going to disclose in your annual report that we're manipulating our earnings. It's just not something that you would communicate. If you're breaking the law, you're not going to scream it to the world. So if you wanted to figure out what the risk associated with financial reporting manipulation, what you can instead do is use a quantitative model that tries to predict the probability of this occurring. So it's not going to be a perfect prediction, but based on past relationships and based on how companies in the past who have, manipulated their earnings behaved, you can try to use this behavior as a model and see if it fits your particular business and see how probable it is that your business might be manipulating their earnings. So again, risk analysis, and specifically around non-disclosed risks, tends to focus more on quantitative models, because both bankruptcy risk and financial reporting manipulation risks are to do with using quantitative models to try to estimate the probability of these things occurring. Has everybody here done econometrics? No. Statistics? Yeah, statistics. So even if you haven't done econometrics, you would have done statistics. If you've done both and don't remember much, that's all right. I don't expect that there's a huge amount of retention there. But for this homework, for example, what you're doing is estimating the probability of bankruptcy, or at least that's the first thing that you're doing for this week's homework. So what you're doing for this week's homework, for example, is estimating the probability of bankruptcy, so this probability of default for H&L. The way that this model works is that it is a quantitative model. We can see the equation there in cell B14, for example. If I zoom in, you can see a bit better perhaps. But basically we can see that it says Z equals 1.2 multiplied by x1 plus 1.4 multiplied by x2 and so forth. And then down here you can actually see what x1, x2, x3, x4, and x5 is. So the way that these models work is that you effectively estimate a score. In this case it's the Z score, and you estimate it by looking at financial ratios for your firm and multiplying them by coefficients. So in the sense that in order to get the Z score for the bankruptcy prediction, we take 1.2 and multiply it by the value of the current ratio for our company. So essentially our current assets minus our working capital divided by total assets. We then add 1.4 and multiply it by retained earnings divided by total assets and so forth. Because the idea here is that each individual ratio here is an indicator of distress. So technically speaking, the company should have, for example, profit. So in sense, earnings before interest and tax divided by total assets, it should be a positive number. If it's a positive number, it's going to be less likely to go bankrupt, and so forth. The idea is essentially that you're looking at these indicators because they are indicators of a good or a bad company, and so forth. So again, for this week, what we're going to be doing is estimating a number of these various models. So again, when it comes to non-disclosed risks, we're generally going to be focusing on bankruptcy risks and financial reporting manipulation risk. So generally speaking, when we're looking at bankruptcy risks first, what we're looking at specifically is really around credit risk, because bankruptcy risk is really the extreme in the sense that credit risk, and somebody might go into problems around with repaying their creditors. That's one thing. At the extreme, we have a firm that essentially is going bankrupt because they failed to pay their creditors. So when we're looking at credit risk, is something that technically is primarily of interest to lenders, but we are also interested from an investor perspective, because when we see takeovers, when we see mergers and acquisitions, companies usually don't buy a well-performing company. So when you have a takeover offer, it usually means that you've been underperforming. Because when somebody takes over another company, it's usually because that company is underperforming, because the buyer knows that if I change a few little things, I can actually improve the performance. So the idea is that usually when we have a takeover situation, the target will to some extent have some bankruptcy risks associated with it, because it will to some extent be in some form of trouble. So again, when we're looking at analyzing credit risk, if you're looking at it from a creditor perspective, there's a whole range of things you could look at. For example, you could look at why does the company need a loan? Does it have good credit history? Does it have positive cash flows and so forth? So these are all kind of qualitative measures. What we're looking at specifically when we do bankruptcy risks is trying to quantify these. So instead of looking at these qualitative indicators, we're going to try to quantify various aspects and factors of a company to try to see if we can use these to try to predict the probability of bankruptcy. So again, the focus of the first part of today is really about trying to understand how we predict bankruptcy. And really, bankruptcy risk is really the idea that we're trying to predict whether a firm is gonna kind of go bankrupt in a sense that it's gonna cease operations. Technically speaking, if we're looking at the term bankruptcy, it's a very absolute term. But generally speaking, when we're looking at bankruptcy, it tends to be a continuum in some form of way or another. Because generally speaking, you'll kind of have some problems around credit. You might go into distress. You might then go into reorganization, or you might go into bankruptcy and then reorganization, and then you might reemerge depending on which jurisdiction you're in. But basically, there's many different situations. But generally speaking, when we're looking at all of these together, it generally just means that the firm is in some form of a distress in terms of one way or the other. And what bankruptcy prediction models tend to do is that they try to predict the stage before falling off the cliff. So we tend to try to find about, I guess, the probability of default 1 year before default happens. So in the sense that we're not trying to predict whether the firm is already going to be bankrupt. We're trying to predict whether the firm is going to go bankrupt next year. So we're always trying to look about a year in advance. So again, as I mentioned, generally speaking, prediction and bankruptcy risk prediction, the most important user of this tends to be lenders. So if I look at any bank out there, if a company tries to borrow from that bank, they will use some form of a bankruptcy risk prediction model to understand what the risk associated with this loan is. Because again, when you make a loan, you need to make sure that you charge them an appropriate interest rate, and that interest rate is completely dependent upon the risk associated with that loan. And again, you can use a bankruptcy prediction model to try to basically price the rate. Now again, as I also mentioned, investors will also be a stakeholder here, because again, if you want to invest in a business, you're hoping to get returns in the future, but on the other end of the extreme, you might actually be investing in a firm that is going bankrupt, so essentially you have no returns and you lose your whole investment. And again, when we're looking at takeover scenarios and takeover situations, a lot of the times investors are actually buying companies that are in some form of trouble in one way or the other. It might not be at the extreme in the sense that the company might fail next year, but it will generally be that either the sales are stagnating or that there's some form of opportunity to try to improve the business. Because again, when a company is doing well, its stock price is generally high. If the stock price is high, the company generally won't be a takeover target. Takeover targets are, generally speaking, companies that are undervalued because they're not performing at their potential. But again, when we're looking at other types of stakeholders like regulatory authorities, because generally speaking, ASIC or even government or even auditors or management, all these people will generally have an interest in making sure that the company does not go bankrupt. So all of these people will be looking at bankruptcy risks. For example, an auditor, when they issue a going concern opinion, they need to have some form of assurance that the company will be continuing operations. One of these things is that they might use some form of a bankruptcy prediction model to try to basically say, well, the risk of bankruptcy is extremely low or maybe non-existent, so thus the firm is going to be continuing on as a going concern. So the way that we, I guess, look at today's session, I guess, bankruptcy risk specifically, is that bankruptcy risk models, and specifically the quantitative models, they look at indicators of distress. And indicators of distress is really the idea that companies that are going bankrupt generally differ from companies that don't go bankrupt. So it seems kind of obvious, but basically this is what the whole model is based upon. Because technically speaking, you could look at other types of indicators. In a sense, you could look at the fact that the company has a cash flow shortage. If they have too little cash flows, again, it makes it risky. If they're not paying their suppliers, again, an indicator of distress. If they have an inventory buildup, well, generally that might mean that the company is not selling their inventory. They might have low sales and so forth. Again, an indicator of distress. And again, just because you have one of these does not necessarily mean that you're going to go into bankruptcy, but it is an indicator that kind of differentiates companies that do well from those that do poorly. But when we're looking, I guess, the ones and things that we're going to be focusing on today is really around financial ratios. So generally speaking, when we're looking at bankrupt firms and non-bankrupt firms, they generally differ quite significantly when it comes to their financial ratios. Before we actually jump into this, I just wanted to show you this little slide. So this slide summarizes the ratios for, I think, about 130-ish bankrupt firms, about 1 year before they went bankrupt, and then about 100-ish firms that did not go bankrupt, so basically the normal ones. So what this basically shows quite clearly is that these firms differ in terms of some of these key ratios. So for example, if we want to look at liquidity, which is one of the most easy ways to figure out whether a firm will have problems with repaying debts, we can see that bankrupt firms generally had a quick ratio of below 1, whereas I guess non-bankrupt firms had a quick ratio above 1. When we're looking at leverage, we can generally see that the companies, I guess, don't necessarily differ that much, but we do see that bankrupt firms have, generally speaking, less equity in relation to their liabilities. So they tend to be more leveraged. If we're looking at profitability measures, again, it becomes slightly more apparent in the sense that, for example, if we're looking at EBIT, so return on assets, we can see return on assets for non-distressed firms should be positive. For those that are in distress, they're negative. So based on these types of relationships and general kind of differences, we can start to understand how some of these models might work kind of underneath. So generally speaking, again, there are a whole bunch of things that you can use as indicators, but if we're looking at, I guess, academic research specifically has tried to use financial ratios because it's very easily accessed. So you can get it off Bloomberg, you can get it from the financial reports and calculate them, so you have access to them very easily. So academic research has tried to use some form of a prediction model for probably about 50, 60 years now. So the earliest models were back in the 60s, and back in the 60s, essentially people just started to look at individual ratios, such as we looked at the slides previously, in the sense that we comparing bankrupt firms and non-bankrupt firms, look at the ratios and see where do they differ significantly. So one of the first studies by Beaver basically identified 6 ratios that he thought had a significant difference between firms that went bankrupt and those that did not go bankrupt. So this provided one of the first kind of evidence-based ways to try to differentiate between bankrupt and non-bankrupt firms. So again, a lot of these things and a lot of the ratios that Beaver identified, they're somewhat logical and rational in the sense that one of them is profitability, so net income divided by total assets. So your return on assets, more or less. There's also total debt divided by total assets, so long-term solvency risk. We have current assets divided by current liability, which is more to do with liquidity. But the idea is that Beaver identified 6 particular ratios that we can definitely see that there's a difference between bankrupt and non-bankrupt firms. The only downside with this, and I guess one of the major limitations with this kind of approach, is that we don't know how important each ratio is in relation to another. So we don't know whether profitability is more important than long-term solvency risk. We just know that both of them tend to differ between bankrupt and non-bankrupt firms. But say, for example, you have a firm with low solvency and low profitability. And then you, on the other hand, have a firm with high solvency and high profitability. So the idea is, how does the combination of these kind of work together? So again, when we're looking at the Beaver, and I guess the previous slide, the Beaver study basically looks at a univariate model. So depending on how much you remember from your econometrics class, univariate model just look at one variable, so one ratio at a time. Multivariate looks at a combination of them together. So you get like a nice little equation. So again, when we're looking at the Beaver study, that was basically the first step into bankruptcy prediction. And again, it used univariate analysis because we tried to identify individual factors or ratio. So again, it provided with a nice little start, but the problem is it does not tell us how important each ratio is relative to one another and how a combination of them might work together. Because sometimes you might have a firm with, again, low profitability, so it looks bad from one single ratio perspective, but they might have high solvency, so they don't actually have a lot of debt. So the idea is that we need to not only account for them individually, but we need to also consider how does the combination of them work together. And again, as I already showed this slide, again, the way that these things work is that we basically exploit differences between these two groups. So do you guys, I don't remember exactly what you do exactly in econometrics. Do you run regressions and stuff? Do you remember how you run regressions? Kinda. Did you use like SPSS, or what did you use in terms of programs, for example? eViews? Sakar teaches it, yes? Okay. Yeah, so if you've used eViews, again, I know you probably might have not understood how it works underneath, but all eViews does, all these statistical packages do, is that they find trends or patterns in the data. So you might have like 200 observations, you might have 100 observations of bankrupt firms and 100 observations of non-bankrupt firms, and it finds, well, oh, there's a huge difference between bankrupt and non-bankrupt firms when it comes to the quick ratio. So let's try to find a general pattern. And then the statistical program basically tries to estimate a line of best fit by combining multiple ratios together. And if you remember, what you usually get at the end is a estimation where you see the coefficients and the significance levels. So if something is significant, then that can predict the outcome. So essentially you can explain the variability in the dependent variable. And similarly, when these kind of bankruptcy models are developed, they're basically doing some form of a regression approach that you guys did in your econometrics class by looking at the general relationships and the patterns in the data. So when we're looking at, for example, the Altman model, so what you're doing for your homework, again, this is basically numbers, and specifically the coefficients are numbers that you would have gotten when you ran eViews or SPSS or whatever program you used. So that would be the results of your regression. And it will tell you that these 5 variables are significant in predicting bankruptcy, so you can use these coefficients in the prediction. And that's kind of how it works. So it's not like a black box approach, because you could theoretically estimate it by hand, even though it takes you a long time. But the idea is, again, we're just looking at patterns in the data.
The coefficients in that Altman formula, have they just been estimated, like everybody used those ones, they've been estimated a long time ago?
Yeah, so you're kind of pointing out to one of the problems with this is that, for example, the Altman model, which we'll cover shortly, it was developed back in the 60s, so it was after Beaver, but it was basically the first really popular multivariate model that has multiple variables together. But again, back in the 60s for about 60 companies in total.
Yeah.
So we're now in 2018, which is about 50 years afterwards, and people still use this model. Not because it's super accurate, but because it's actually quite easy to understand. There's been like thousands upon thousands of other models developed after this one, but they might use like non-linear effects. They might have 20 different variables, and sometimes they might have variables with coefficients that don't make sense, where it might be a coefficient that is negative for something that should be positive, in the sense that it's a profitability variable, but somehow the coefficient is negative, so it's actually predicting higher probability of bankruptcy. So the Altman model, again, it's something that was developed back in the 60s, but it's still quite relevant today. So again, because there are a number of deficiencies with univariate analysis, in the sense that we can only look at one thing at a time, we don't know how the combination of these ratios work together, people basically moved on to develop multivariate models. So when you run a regression, you usually try to develop a multivariate model. So again, it allows you to look at multiple ratios at once and figure out their relative importance and how the combination helps you predict something, and in this case, bankruptcy. Again, the most popular one in terms of the bankruptcy prediction is the Altman Z-score from back in 1968. And again, this model, super old, but still used to this date. It's not the most accurate model, but again, because it's simple, it tends to stick over time. So whenever you develop something very complex, people are somewhat afraid to use it, because if it's something complex, you're not going to understand it. So here's basically how it kind of works. So the Z-score basically looks at 5 ratios that are all supposed to be indicators of bankruptcy versus non-bankruptcy. So we have net working capital divided by total assets. We have, I guess, retained earnings, so that basically our past profitability. We have EBIT divided by total assets, which is about the current profitability. We have market value of equity divided by book value of liability, so more about the solvency or the leverage. We then have sales divided by total assets, which is about asset efficiency. So we have different aspects of a company's performance. And again, if you go back to the previous week when we looked at ratio analysis, and we have all these different categories such as profitability, liquidity, and so on, this model is actually quite logical because it tends to take one ratio from each category more or less. So the way it works is that you calculate each ratio for your company and you multiply it by those coefficients, sum it all up, and you get the Z-score. You then use that Z-score and use the decision rules that Altman decided on, basically that if your Z-score is less than 1.81, it indicates a high probability of bankruptcy. If it's above 3, there's a low probability, and if it's somewhere in between, it's kind of a gray area where we don't know what's going to happen. But again, this model is super simple, but in some ways it's somewhat limited in the sense that it's not necessarily perfect and it could be a lot better. So again, if we're looking at some of the essentials, technically speaking, the Altman model was developed for manufacturers in the 60s in the US. So it's not necessarily going to be super accurate for non-manufacturing firms, but Altman has since then developed another model for non-manufacturing firms. Technically, the original data was based on 66 firms. So again, back then was when computers weren't really that advanced. Doing any form of regression based on 66 firms would have still taken ages. This day, you can run a similar type of analysis on millions of firms in seconds. But again, people still use this model, so it's not completely irrelevant. And again, when we're looking at the Altman model, it's not great, but since then, it's still used quite widely. So for example, if you wanted to apply to H&M and French Connection, you basically look at the coefficients for each variable. You then look at the ratio for that particular company. So for example, for H&M, the EBIT to total assets is 0.199 or 19.9%. You multiply that by the score. You multiply the ratio by the coefficient and you get the score, and then you sum up all the scores. So essentially you're estimating the Z function. Because in this case, H&M is above 3, it's quite safe. On French Connection, on the other hand, is below 1.81, so it actually has a probability of going into default. So again, these models, they're not perfect, but they're a great start just to try to, I guess, understand the probability in general sense. Yes?
How accurate has it actually been in predicting?
Generally speaking, so when it was first developed, it was probably touted as being like 90% accurate. If you were to look at it today, you'd probably find 70, 80% maybe. Still quite good, but if you think about it, 70 to 80%, what does that mean? And what does that 70 to 80% relate to? So if you have a sample of 100 firms, generally speaking, maybe 1% of them would go bankrupt. The Altman model will probably predict like 20% of them are going to go bankrupt. So you think that 20% of them are going to go bankrupt, but only one of them actually did. So the idea is that if we're looking at percentage terms, it sometimes seems impressive, but then if you think about all the false positives you get, it's actually not necessarily super accurate. But again, it's a great way just to get an initial sense of the associated risk. Because again, even though it might be a false positive, it means that there's something in your ratios that is weird. If you yourself can't explain what that is, well, then you have a problem. But again, for example, I think one of the groups is doing Time Warner, and Time Warner is known for having negative retained earnings. When you have a negative retained earnings, it generally means that the model will almost always predict that you're going to go bankrupt. Because again, back in the 60s, it was completely unknown for a company to have negative retained earnings. Because since then companies have grown super large, have had acquisitions, goodwill, then written them down, it's quite common these days to have that. So again, things that were relevant back in the 60s might not be relevant today. That's kind of one of the issues here. So again, because it's not amazing, Altman did modify it later on. So for example, he modified it for the non-manufacturing sector. What does that mean? Well, technically all that meant is that he dropped one of the variables. So you're also applying the model that he developed for the non-manufacturing sector in the homework, and all that did is it basically dropped the fifth variable, which was your asset efficiency. Because asset efficiency is something that is extremely important for manufacturing firms, but not that relevant for non-manufacturing firms. Again, when you drop a variable and you estimate the regression again, you get different coefficients. So that's kind of explains why the coefficients are different. But again, the variables are exactly the same, with the exception of the fifth one, which is sales divided by total assets, which is not in this model. Are you guys completely confused or no? Pretty straightforward. So again, just using a bunch of ratios to try to predict bankruptcy. That's all it does. And again, better than nothing, but not perfect. So I wouldn't necessarily just look at this and say, oh, it's predicting bankruptcy, it's going to go bankrupt. No, maybe it's going to go bankrupt, but more likely than not, it just means that the firm is some form of a distress or another. So again, if we wanted to look at just bankruptcy research in general, it's actually quite useful to understand what tends to drive bankruptcy in general, because there's been thousands upon thousands of different models developed since Altman and Beaver, and some of them are really, really complex. But if you start to look at the overlap between them, so which ratios do they look at and which ones are usually identified as being important, generally it relates to these type of factors. For example, when we're looking at investment factors, the relative liquidity of a firm's assets. So a firm can have a lot of assets, but if all of them are illiquid, so essentially you just have long-term assets, it means that you don't have short-term assets, and you need to have those liquid short-term assets to pay your current liabilities. So the more liquid your assets are, the less likely you are to go bankrupt. On the flip side, technically, liquid assets don't tend to actually generate profits. So liquid assets are more or less the assets that you have within the firm to cover your short-term liabilities and so forth, but they don't generate much. Whereas your illiquid assets, such as your manufacturing, your plants and so forth, those are the ones that are generating returns. So there's a trade-off technically. So you want to have liquid assets, but you also don't want to have too much of them. We have things like asset turnover. So again, the fifth variable in the Altman Z-score. And again, asset turnover is important because again, it tells you how efficient you are at using your assets to generate revenues. We then have things like financing factors, in the sense that we have the relative proportion of debt. So what is the leverage of this business? The higher the leverage, the more risk. So it seems like means quite easy to understand this. But also technically we need to consider the proportion of short-term versus long-term debt. Because again, debt is not debt. If the debt is long-term, it's not a big deal because it's not due right now. If it's all short-term debt, even if it's a small amount, it might be problematic for a firm. And again, we have things like relative level of profitability. So if your firm is profitable, obviously you're not going to go bankrupt that easily, because if you're profitable, you generally can get a loan from a bank, even if you have kind of short-term struggles when it comes to cash. We have things around variability of operations. So the idea that the firm might have very highly fluctuating profits or revenues, generally a bad sign, because it kind of means that you're most likely a cyclical firm. So cyclical firms are basically ones that are following the economy, and that's not necessarily a bad thing always, but it just means that you generally have a higher probability of going bankrupt, because if the economy goes down, your sales go down, your profits go down, and you might kind of come into problems when it comes to cash flows. Again, there are some other variables used in research, things like size, because technically speaking, large firms less likely to go bankrupt because they tend to have access to financing that small firms don't. So a large firm can go to the bank, they can even try to issue public debt and so forth. Where there's a small firm, they can usually only go to 1 or 2 or 3 banks and so forth. Growth, qualified audit opinion. So again, if the auditor thinks you're not going to survive, generally a bad sign. So a lot of these things kind of make sense, I have to say. Question, do you want a break? Yes or no? Yes, you win. All right, so come back in 10 minutes and we'll continue on with the financial reporting manipulation risk. All right, so let's continue with the lecture. There's not much left, so that's good. Generally speaking, what we've covered so far is what are some of the disclosed risks. Part of the undisclosed risk, which is what we've covered so far, is really bankruptcy risk. And what we're going to be doing last is really around financial reporting manipulation risk. Again, this is very closely linked to accounting analysis technically, but as I mentioned in the Accounting Analysis Week, it's almost impossible to identify real manipulation just by doing simple accounting analysis, because most firms that are doing shady stuff won't be very transparent about it. So kind of to address this, you might be looking at using one of these kind of prediction models, but for financial reporting manipulation. But again, they work very similar in a sense that in this case, what we're going to be looking at is the Beneish M-score. So the Beneish M-score basically looks at 8 variables in total. And again, the way that the model was developed is very similar, because Beneish collected, I think, around 70 or 80 companies. 40 of them, I think, were, or maybe 70 of them actually were manipulating their accounts. Then he found so many companies that did not, and then again threw it into a statistical package to try to find the differences and the patterns between these firms. Now, if we're looking at this particular model, it is a lot more complex. Has anybody done the homework so far? Oh, we have a few. It was probably not fun to calculate this, because there's like this divided by that, divided by that, divided by that. So it's actually quite difficult to calculate in the sense that it's not as easy as the Altman model. So the Beneish model, again, it basically looks at about 70 manipulators and then matches them with non-manipulating firms. And what he identifies is 8 variables, and specifically 8 kind of index variables that look at the changes throughout time. So if you're looking at, for example, the Altman model, well, the Altman model generally just looks at a ratio at one point in time. What's different about the Beneish model is most of these ratios are index variables. And index variables basically compare something last year to this year. So it looks at changes rather than just level. So it's a kind of a big difference between these two. Again, looks at 8 different things, and it works similar in the sense that you have the value for that variable multiplied by a coefficient, sum them all up, and you get an M-score. The big difference here is really around the fact that, one, we have an intercept. So if you remember back when you did econometrics or something, you sometimes estimated a model with an intercept or a constant. That's what it is. You basically just add it to your score to get the final value. And the idea here is that the cutoff is if the number is greater than 2.22, there's an indication of manipulation. Now, if you're looking at the individual variables, it might be hard to understand why do we look at all these individual variables to try to predict financial reporting manipulation. Again, some of these you might actually remember from accounting analysis. Now, we didn't use them specifically this way, but one of the things that we did look at when we did accounting analysis is we compared our accounts receivables to our sales. So we looked at the growth in both to see whether there's a differential growth. So if you're looking at, for example, the first variable DSR, so sales receivables, we're looking at the ratio of receivable to sales for this year and compared to the ratio of receivable to sales last year. The idea is that if you have an increase in the receivables in relation to sales from the year prior, it indicates that maybe there might be something wrong. Again, in itself, nothing bad, but again, it's one of the indicators, because again, if you have an increase in receivables, that's generally not a good thing, because they should technically grow at the same rate as sales. So if both of your receivables and sales have grown by 10%, that ratio DSR would be 1, because there would be no change. Because if there's proportional growth, there's no change, there's not going to be anything in terms of a red flag. We have some other things like the gross margin index. And the gross margin index basically just looks at your gross margin to see how it has developed over time. And the idea here is that if you have a decrease in your gross margin, doesn't mean something is bad, it just means that you might be inclined to try to manipulate sales or manipulate any accounts. Because if you have problems with profitability, you generally kind of come under scrutiny. So if you think about like a manager gets evaluated based on their performance. So if the profitability goes down, the board of directors will be like, what's happening? Why are you not doing a better job? So from a manager's perspective, you want to avoid these things. So whenever you see a drop in profitability, it kind of increases the incentives to try to do something essentially. We have other things like the asset quality index, and that's the idea that we're going to be looking at the proportion of our assets that are more fixed type assets. So property, plant, and equipment, things that are not easily manipulated. Because if we're looking at our total asset figure, that total asset figure might be 80% based on goodwill. And what we know about goodwill is it's highly, highly subjective. So what that ratio does is it looks at how much of your assets are quality and high quality assets that are hard to manipulate. We have things like the sales growth ratio, which is really about, sales growth index, which is again looking at changes over time. And what we're looking at here is the idea that we want to make sure that the company is not growing too fast. It might seem like a weird thing to look for because usually people want high growth, but high growth also means that there is a higher incentive to manipulate earnings. So again, individually, they don't mean much. When you combine them together, that's when you start to see a relationship. And again, things like depreciation index. So if you remember from accounting analysis, we did a red flag around depreciation rates. If there's a huge variability, something's happening. Again, by itself might not be a big deal, but again, when you combine it together with other things, it might mean something. So the idea is that depreciation should be stable over time. If there's a change, that means something, and we need to understand why that's happening. We have other things around SG&A expenses, and the idea is that when we see an increase in SG&A expenses, we might see a firm that is not doing so well. When they're not doing well, again, it creates an incentive to do bad things. We have things generally like higher accruals. So again, accruals in general are not bad in itself, but the more accruals you have, the more you're likely to more or less manipulate your earnings, because you manipulate your earnings by using accruals. So accruals essentially become an indicator in itself. And then finally, we have the leverage index, which is really the idea that if you have an increase in leverage, again, it just predisposes the company to manipulate earnings. So again, all the Benich model does is it generally looks at changes over time. So in the homework, those have already done it. So one of the questions I asked in the homework is for you to basically think about why do they look at different things. So the Altman model looks at kind of static values in the sense the current ratio is this, the return on assets is that, whereas the Benich model looks at ratios in relation to the prior year. So it looks at changes from year to year. Again, I don't expect amazing answers that are like perfect. I'm just looking to see whether you can try to think about why this might be and why these two models are looking at it from a different perspective. So again, when we're looking at today, again, we kind of looked at a few different things. So if I look at for your project specifically, you're going to be estimating these quantitative models. You're also going to be looking at all the disclosed risks, but that's quite easy from a, I guess, intellectual perspective, because you're basically looking at disclosed risks. You put them into a matrix and figuring out what they might impact. But when you're looking at these quantitative models, you need to remember they're not perfect. So most of these models have been based on sample sizes that are very small. So I guess the Benish model was about 150-ish companies in total. The Altman model, 66 companies in total. So it's very small sample sizes, and you can't always use these small sample sizes to generalize for all companies in the world, especially because most of these models have been developed on US samples. So if you look at, for example, the Altman model, well, the Altman model is based on US GAAP in the 60s for manufacturing firms. If you try to apply it to a service company in Europe that uses IFRS in 2018, it might not be that relevant. And again, when we're looking at time periods, again, developed a long time ago, if things have changed, they might not be as relevant. Again, some things don't change, so some things don't change, like a profitable firm will have a lower likelihood of going bankrupt. That stays the same. But for example, one of the things in the Altman model is the retained earnings. It's very common these days that you see large businesses with negative retained earnings, and that usually drives the Altman model to predict that they're going to go bankrupt. We have the fact that most of these models are around publicly listed firms, because those are the ones that are easier to get data for. But generally speaking, most firms out there are private. And then finally, we also have something that's just the luck factor. So when we're looking at any kind of statistical model, it tries to find a pattern. It doesn't mean that that pattern exists in reality. It just means that the data can be categorized based on some form of pattern between these two groups of firms. So just because you find this pattern for this group of firms does not mean it will hold in reality, because it could just be that that is a pattern that is for this particular sample. So there's huge amounts of limitations around quantitative models. So I'm not saying that we don't use it, but when we use them, we need to consider them in relation to all other things. So they're basically just another indicator for us to use. So for example, if I see in my case that H&M, let's see, H&M is a pretty safe company, because if I look at the Altman Z-score, so it should be above 3, it's like 17.85. So it's hugely above it. But if you look over time you actually see a decrease. So now it's down to 10 in 2016. So even though it's still a safe company, it might still give me some information about what is deteriorating, because something here is decreasing over time, and your job then becomes to figure out what is actually causing the Z-score to decrease over time. And even, for example, similarly, if you find that your company is being predicted to go bankrupt, you need to figure out why that is. And the way you figure it out is you try to figure out which ratio is it that's driving the prediction. So in H&M's case, I can see here, for example, the big changes from year to year. Generally speaking, what I can see is the fourth ratio has dropped from 19.28 to 11.87, and if you go down to the fourth ratio, it's the market value divided by total liabilities. So essentially their leverage has to some extent gone up. So what you want to understand here is really, why did this happen, and is this some form of a relevant piece of information for you? So again, it doesn't mean that you're going to say, yes, it's going to go bankrupt. It's just an indicator for you to use. And similarly for the Benish M-score, just because it says low risk doesn't mean it's safe. Just because it says it manipulates does not mean it manipulates. It provides you with some form of information. So for this week, what I would actually suggest in terms of, I guess, to start the process. So on Thursday, what I'll have you do is try to do something similar to the example I posted, in the sense that I want you guys to work on a risk matrix. So one thing that you will be doing, obviously, is the quantitative models. You've done that in the homework, so you can just do it quite quickly for your business. But in addition to that, you will be doing a risk matrix of some kind where you're going to be looking at all the disclosed risks and all the other risks that you might have identified yourselves and try to estimate or think of their probability of occurring and the potential impact they have on the business. And again, when you're thinking about impact, it's really how will they impact the margins, how will they impact the profits, the revenues, and so forth. And again, I think this one is a really nice example just because it provides a visual of how it works. Because again, you could provide a table of this as well, but this provides a very nice overview of all the risks with a nice little visualization.
Did you say the students made that?
Yes. So again, so these are like winners in the CFA Research Challenge. So this is like a global competition, so it's not just anybody. So these are like the best of the best of the best. But I think even Bond participates in the CFA Research Challenge as well, and generally the quality of the presentations is like top notch. Because again, whenever you participate in any of these moots or challenges, there's recruiters there. If you do well, people basically see that you can do stuff. And again, if you want to do a nice presentation, all you really need to do is find a template and use that template. So it seems like a weird thing, but if you Google PowerPoint templates, you'll usually find that you can buy one for like 10 or 20 bucks, which provides you with like nice icons and basically infographic type of material. So it's not impossible, but it takes a lot of time. So I would say focus on the content. If you have time, make it pretty, because pretty does count in the end, because people do get biased by pretty stuff. But again, focus on the content. Because again, you could say all of this in a very sterile way, but by making it pretty, it just seems impressive. It shouldn't, but it does. That's kind of how it is. What I would suggest for the rest of today is, if you don't feel like running out, is go into your annual report of your company and see if you can find the disclosed risk for your firm. Because if you can find the disclosed risk for your firm, you're basically starting what you need to do on Thursday, which is really to identify them and start to put them into some form of risk matrix structure.
Is that the only section?
I think so.